I think everything that they've done is trying to stabilize the economy to make sure that the debt issue and property sector do not spill over to the banks. And indeed, when we looked at whether or not the current crises or the problems in the property sector can spill over to create a much bigger systemic risk in the banking system, we actually concluded the banking system is okay, it's quite sound.
All right, welcome back everyone to our latest market commentary. This is where we talk about our latest views on the market and we share our insights about them. My name is Albert. We are joined here today by Stephanie, our Chief Investment Officer. Hi Stephanie, how are you?
Hi Albert, hi. This is the first time we've done a live commentary.
Yeah, very special session today where we do it together. Today we'll be talking about two very special countries, be China and India. So these are two largest countries in the world, very big population, but what separates them, we have different aspects. We can talk about economics, politics, social, and yeah, I think, Stephanie, let's talk about India first. For India, they are one of the fastest growing countries in the world. I think this year itself, they have grown about 6.9%. Look at the stock market, I think it's up. The MSCI India is up about almost 9% in US dollar terms. So one of the strong pillars that's supporting India is its population itself. So it's a very young population, growing middle income segment, and that's great and all. But one of the concerns surrounding investing in India itself is the lack of FDIs going into the country, lack of government spending. You can see that in the infrastructure of India itself. It's not that well developed. Connectivity is an issue. That's one. Another issue is also about inflation. India, like many other countries out there, they are a key importer of oil itself. So as we have seen, oil has gone up in prices. They have suffered from inflation like many other countries, and as a result, their currency has also depreciated quite a bit. So given these two concerns, one is that lack of FDIs going in there. The second one being the depreciation in their local currency. Is India attractive given how the market has performed, how the economy is growing, how their population is kind of it seems to be very well? What do you think about that?
I think if you look at year to date, obviously there's great divergence of different market performance. Now the S&P has had, double-digit returns. India, as you mentioned, is almost kind of 10% return as well. If you look at kind of other emerging markets, I mean, the story is less rosy, right? MSCI China is basically, very much lagged in terms of returns year to date, and perhaps over the last 5 to 10 years as well. So I think if you look at the India story, definitely there's a lot of excitement. We constantly, for example, monitor Google searches for Indian equity returns and also interest for India. I mean, those are very high, particularly given this year's outperformance. A lot of investors are asking us, I mean, should we actually invest in India? Is this the right time? Are we too late, etc.? So this month in our Sell Insight, we took a deeper dive into the India story. In particular, we looked at what's driving India's growth going forward. Because if we look backwards, it's pretty obvious that India has had pretty tremendous growth. As Albert, you mentioned, population growth or the population dividend is one significant driver of India's growth story. This has been quite well known, particularly, I think the headline this year is that India basically surpassed China in terms of the population in the country itself. So if we look at what drives economic growth, typically GDP growth can be driven by two things, right? Number one is technology improvement, which is kind of what the US is relying on, which is why that drives the economy going forward, which explains equity returns. The other potential for GDP growth is definitely population growth, and here is where India is reaping its population dividend. Now, as we look forward, this picture is going to be even more favorable for India, because if you look at kind of the population pyramid and also the construction of the population in China. Number one, China has a kind of a more aging population, where India actually is much younger. So for example, if you compare the median age for Indians is 28 years old, compared to, I guess, close to 40 years old for developed markets, and also that includes China as well. So a young population supports, a young working population supports economic growth much better. In terms of the growth in the population itself, also the projections that we've seen is that India will be growing at 0.5% CAGR for the next decade or so, whereas China actually sees a shrinking population. Now there are other countries that are growing populations as well, but the scale is quite different from what India is experiencing. So I think that's kind of the bull case for India. Now onto some of the concerns that have been kind of, I guess, reigning in India's growth. You mentioned two. Number one is investment. Indeed, if you look at investment as a percentage of GDP, that's where India has been lagging, right? That percentage has been 25% historically, compared to over 30% for China. And as a developing market, definitely you need more investment to drive growth. But we're actually seeing kind of changes on the margin in this front from two factors. Number one is private investment. Number two is public investment. So on the private investment side, given a lot of reforms on the tax regimes and infrastructure, etc., we're now seeing foreign investments going into India or going back into India. Some of that, of course, is driven by the kind of the concerns or kind of the relations between the US and China. So a lot of companies are actually diversifying their investment so that it's not so focused on China, and India is reaping the benefit of that. I think secondly, if you look at the government investment themselves, India government investments actually have more than doubled in the past few years, and this is directly relating to upgrading infrastructure, upgrading kind of social welfare, etc. So this is also beneficial for India's growth story. The second big concern is on inflation. Yes, historically, India's inflation has been quite volatile and very, very significant because of the skew towards food, and also because the RBI, which is the India's central bank, has not had an inflation targeting mandate. So, we're all very familiar with the Fed trying to target 2% inflation, or ECB or BOE, etc. Actually, RBI just implemented their inflation targeting a few years ago in 2016. And when we look at kind of the inflation number for India, indeed, inflation has come down quite a lot since the RBI started targeting. And why do we focus so much on inflation? Because as a foreign investor, our investment into the Indian equity market is not based on the Indian local currency, it's not based on rupee, right? It's based on US dollar or whatever other currency that your home currency may be based in. So we focus on the US dollar return of the Indian stock market. And a big component of that is the currency return, right? If Indian rupee actually keeps depreciating, you need to take into account when you calculate a total return. And inflation, a high inflation, actually causes a depreciation of currency versus the US dollar in particular, and that has eaten into returns over the last few decades. Now, as inflation kind of stabilizes, then you can expect the US dollar return to deviate that much from the rupiah return, which is also great for a foreign investor. So I think in conclusion, we're seeing kind of positive changes on both the investment side and also the inflation side, which helps to kind of increase return into the future.
All right, thanks. So that's the more positive side of things on India. If we shift gears a little bit towards China itself, where it's just been fairly gloom and doom, if you've been following the news, you have the demographics where they have been overtaken by India itself. They are moving towards an aging population. You have the stock market, which hasn't been doing very well at all. In fact, it has reversed the recovery that we've seen when China opened up from COVID last year. We have had policies from the government trying to boost consumption for consumers. We had them trying to reduce interest rates, allow banks to hold less reserves so that they can put more money into the system itself. All these different policies seems to not really inspire confidence within the investor community itself, and they seem to be trying at least to address it. In fact, I think today we have seen even the sovereign wealth fund coming out to buy stakes in a small stake in certain banks within China. So trying to inspire confidence. Given the whole, all this the negativity around China, what can one do about it? Right? Is China really still investable at this point in time?
Right. So I think definitely the China story is a lot more nuanced. And when we look at the China story, I think we have to separate kind of the structural versus the cyclical. Now, there's a lot of structural concerns, like mainly relating to the population, trajectory, and also, policies, etc. Of course, in terms of the international relations versus China or with China, that is also a structural concern. But I also think if you look at kind of the cyclical component of it, cyclically we're at a very, very low point in terms of the China economy, and that gets reflected into valuation as well. So if you look at the US or kind of in terms of price to earnings, S&P is now trading at 18 times still. China is trading at single digits. Now, so that means that the equity market or the market has discounted a lot of these cyclical concerns. And I think if you look at the margin, there are some kind of more encouraging signs. So it's not all kind of, kind of gloom and doom there. If you look at the PMI, which is a very, very good kind of indicator of the cyclical strength of the economy, actually in the latest reading in October, the China PMI actually surpassed 50 for the first time in many, many months. And it's been steadily climbing from the trough of below 49. So in the last few months, we've kind of seen a gradual recovery of the economy. Not to mention, of course, like as you said, the Chinese have actually started injecting liquidity. So in the past few weeks, we've seen the central bank injecting over 700 billion in terms of renminbi in terms of liquidity into the system. I think everything that they've done is trying to stabilize the economy to make sure that the debt issue and property sector do not spill over to the banks. And indeed, when we looked at whether or not the current crises or the problems in the property sector can spill over to create a much bigger systemic risk in the banking system, we actually concluded the banking system is okay, it's quite sound. So interestingly, I think if you look at year to date, the relative returns of the US regional banks versus the China big banks, they're actually pretty much in line. So the China banks have not significantly underperformed the US counterparts. So I think it shows you that the market is concerned about some areas, but for the banking system, which is important for the economy, there's not much stress there. So I think in conclusion, the question is China investable? I think you have to think about it from a kind of time horizons perspective, right? If you are focused on the much longer term, I think there is some nuance, but it doesn't mean that you shouldn't be positioned in China, because there are still kind of pockets of China that are growing. For example, like electronic vehicles, new energies, these are, or even healthcare, these are areas where China is actually investing a lot, and there could be potential opportunities. And I think from a cyclical perspective, the market is pricing in a lot of the cyclical weakness. So given the liquidity injection, I think China's economy is picking up. It's not picking up as fast as the market wanted or expected at the beginning of the year, but it doesn't mean that it's not turning a cyclical corner. And then finally, when we look at the US manufacturing side of things, it seems like that's bottoming out as well. So from a China perspective, because China exports a lot of goods, right? A lot of like these manufacturing side of things to developed markets and to US. So if the US manufacturing economy is starting to bottom out and pick up, that is also beneficial to China. I guess lastly, if you look at US service, that seems to be topping out. And I think I just mentioned about the kind of the big gap in terms of price to earnings, right? So if you translate that back into required returns, or kind of the returns that these different equity markets are giving you, 18 times earnings means that it's giving you kind of 5% or so return. 8 times, that's kind of double digit or close to 20%. So I think we need to think about what's priced in as well.
Okay. Well, that's kind of what we talked about in regards to India and China itself. If any of you have questions about those two countries, or even on any other topics, just please feel free to post it in the chat box, and we will address them. In the meantime, Stephanie, we have a question here from Wei Ren itself, who's listening in on this, and Wei Ren's asking, there's 2 questions. So the first question is, how should we, as investor, position ourselves to reduce the negative impact on geopolitical issues? I'll let you address the first one.
Okay, so I think I'll make 2 comments. Number 1 is that, of course, there's a lot of geopolitical concerns right now going on. I mean, in Israel, in Ukraine. I mean, these are just kind of ongoing wars or conflicts that doesn't seem to be resolving anytime soon. However, I mean, historically, barring a world war, the impact of a war on asset prices, much broad global asset prices, tends to be quite short-lived. So, I mean, for example, take oil, right? Oil responded in a very knee-jerk reaction to any kind of geopolitical conflict. I mean, we've seen it with what's happening in Israel and Gaza. We've seen it when Russia first invaded Ukraine. However, ultimately, I mean, oil prices and also asset prices respond to economic fundamentals. So the reason why I mentioned barring a world war, because historically, when we had the world wars, it affected all the economies very, very deeply. Yeah. So hence, I mean, it affected asset prices. However, our experience when we look at the data for these kind of more regional conflicts, they tend to be quite contained, and it doesn't affect global global supply and demand for commodities or even or oil. So that's why typically the market reacts in a knee-jerk reaction, and then, I mean, it kind of goes back to fundamentals. The second comment I'll make is that I think we've mentioned kind of very briefly that structurally we think that, I guess, we're entering into a multipolar world, which means that nations will try to compete with each other much more and build independent supply chains and technology, etc. So the best ways as investors to position for this is actually to diversify your bets. So to have not just exposure to single countries or single regions, because I mean it's very hard to predict which one will win out at the end or how the conflicts will kind of evolve. But if you diversify your bets, you can kind of enhance your chance of getting kind of benefits from whoever that makes more technological advancements or whatnot. So I think those are 2 comments I would make.
Okay, great. The next question by Wei Ren, the second part is, when are we going to re-optimize our portfolios?
Okay, that's a great question. So I think for listeners who are new or for investors who are new, we monitor economic data and situations in real-time basis, and we make adjustments or re-optimizations to our portfolios whenever we see a significant change in the regime, right, which affects the kind of the risk weightings of our portfolios. So I mean, when the data tell us to re-optimize, we go ahead and do the re-optimization. So it's very, very hard to say, by when we'll have the next re-optimization. But I mean, what I can say is that the last time that we had a re-optimization was about a year ago in December 2022. And that was due to the fact that we're seeing the world slowing, so going into stagflation. And historically, I guess when we look back into StashAway's history since 2017, on average, we've had a re-optimization every kind of 12 to 18 months or so. So, I mean, that's kind of like, those are historical data that we can sort of refer to.
Okay, great. And then I think we have one more question here. Just asking, Stephanie, earlier when we were talking about China, you mentioned pockets of China. Does that mean that one should be buying broad index ETFs on China itself is not the way forward because you have to be a bit more selective in China?
Right. I think if you think about kind of China itself, right now the index is quite kind of dominated by internet and financials, not so much by property anymore, right? Property used to be a big part of a bigger part of the MSCI China. So I think the great thing about buying a broad-based index is that it'll kind of it'll rebalance itself towards the sectors that are growing. Because 10 years ago, property was much bigger than internet. And as the internet sector in China is driving growth, is growing, automatically, I mean, the index itself rebalances to having a much bigger portion in the internet. Now, of course, it's still dominated by the banks, but banks are a reflection of the economy, right? So if the economy actually recovers, that banks actually do quite well. So I think if you have the time and resources, then of course, I mean, if you can do the research and kind of go into kind of smaller pockets, then by all means, I kind of have exposures to those. But I think as a diversified kind of exposure to the China story, I mean, investing in index is a great way to let the index actually rebalance for yourself.
So I think perhaps you could shed a little bit more light about how can one get exposure to China through StashAway itself?
Right. So on StashAway, I mean, we have on Flex, for example, we have some China-based ETFs, and then also in our general investing portfolio, we have some exposure to China through our emerging market ETF exposure. So I mean, there's various ways that investors can get exposure to China through StashAway. Okay,
great. So there you have it. We don't seem to have any more questions from the audience, so I think we'll have it end like this for today's session. So this is a very special session where we are graced by the presence of Stephanie here, live in KL. So thank you all for dialing in. Thank you for your questions. I hope you all have a good evening. Thank you, Stephanie.
Thank you, Albert. Have a great night, everyone.
Take care.
Take care.